Are early repayment charges allowable for tax purposes? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Are early repayment charges allowable for tax or are they not? Well, this is a slightly more complicated question than we would like it to be because there is specific guidance which describes the position with whether or not it is. So let's have a quick look at how this is fitting together to see whether these extra expenses are going to be allowable for tax purposes or not. Let's start with a corporation tax position and discuss whether this will be allowable. And these will always be included in the accounts because if it's a company that has a loan, then that loan will always be allowable in the company's accounts as an expense within the company. And usually these sorts of expenses would be allowable for corporation tax purposes. The area we're going to have a look at today is going to be more down the income tax route. So these are the ones that you are paying when you own something in your personal name. Are early repayment charges allowable for tax purposes when you own the properties in your own name? So in this case, we are looking at the income tax position to see whether or not these costs are allowable for tax purposes and will help reduce our tax bill. Now under section 24, if they are allowable, then they will be finance costs. So they will be allowable in the interest rate relief or the finance charges adjustment on your tax return. However, the first starting point is, are they even allowed to be on the calculation, as well as where will they end up being shown? So we have some specific guidance in the manuals, although it's a little contradictory. So we're going to have a chat through that today, and then it will be down to your decision whether you think you fit within the criteria, the eligibility, or whether you don't. And depending on that will determine whether or not you're going to be including it in your income tax calculations or whether you're going to have to just ignore it and take it as a cost of doing business that's not allowable for tax purposes. So within our guidance that I'll show on screen, we've got one specific area that we need to be aware of, which is that the following items specifically are excluded from the relief for incidental costs of loan finance. So I'm going to ignore a few of them because they are not what we are focusing on today, but we are looking at specifically point C, which is the cost of repaying a loan or loan stock so far as attributable to its being repayable at a premium or having been obtained or issued at a discount. So the key question here is whether or not the early repayment charges will form part of a premium or break charge or whether they are actually interest expenses for the loan. So it does go on to give additional guidance, and this additional guidance specifically discusses whether a loan repayment is a premium, a break charge, or whether it is just additional interest. So we're looking at some loans which are lower in the early years, and if you want to end that loan, you have to pay a charge which in HMRC's parlance, in their vernacular, is going to be a break charge. So you have a couple of years at low interest and then it changes to a higher interest rate, and when you repay that before the end of that initial contract, there is a break charge, there is an early redemption charge. And whether these break charges will classify as incidental costs of obtaining the loan or not will be determined by the facts of the case. So for each one you will need to assess whether or not it's incidental to the loan or whether it is a large proportion of the loan and what the purpose of it has been. If these amounts are seen as a premium, then they are expressly disallowed and you cannot claim them under tax relief. Premium is not defined for this purpose, nor is there any binding judicial guidance on its meaning, We might therefore expect the courts to look at other sources, so any other legal context, dictionary definitions, common usage, and so on for assistance. In common usage, a premium usually connotates a payment made at above par. So in the context of loans, this would mean some excess over the amount advanced. Although such excess may in certain circumstances represent interest, that is not the case with break charges. It's sometimes argued that break payments are interest because they're calculated by reference to interest that the lender might have received had the loan continued. Interest is payment by time for the use of money. Break payments are made to terminate the loan. They are not using the money over time. So there is very much, as we can see here, a lot of question marks of whether these premiums, these break charges, fall within the premium area, so they wouldn't be allowable, or whether they are actually just incidental costs of the loan, which therefore means that actually they are allowable for tax purposes. Therefore, for each individual case, you need to assess what the purpose of the loan was, what the expectation was, to see whether it was a specific cost. If the intention was always to end the loan early, then it's not really the intention was you knew you were going to be paying that was part of the cost of the loan because you knew potentially you were not going to do it. If it's expected that the loan was going to continue, then maybe that break charge that you're paying now early is a premium because there was no intention of paying that, and it's actually disallowable for the fact that the intentions, the particular facts of the arrangement were that now it is a surprise payment, it's a premium because you weren't going to be paying it. So as you can see, there is very different definitions here, and it may come down to what is the circumstances rather than how it all fits together. Additional guidance that they provide, as we can see, the way the agreement describes the sum is irrelevant. The issue is the reality of the transaction, not the labels the parties attach to it. Whether the payment in question is considered specifically within the loan agreement is provided for elsewhere is not determinative. So the majority of break payments that take the form of a penalty for early redemption of the loan will represent genuine compensation to the lender. In such circumstances, the break payment will not amount to a premium and will therefore attract relief as incidental costs of raising loan finance. So on that basis, for the majority of early redemption payments, these are going to be allowable for tax purposes. What we've tended to find is most high street lenders will require this as part of a way to get finance. So therefore it's part of the agreement, it's part of the arrangement, it's not a premium, it's a standard term within the agreement. So on that basis, they're going to be allowable the majority of cases. However, it's something to be aware of that in certain eventualities, these may not be allowable depending on what the contract says, how it fits together, and the reality of the agreement. However, there is no intention at the outset for a premium to be paid, that more capital is repaid than originally advanced. Instead, any break fee received is compensatory. One of the key cases to just share, which is relevant in this case, is a commissioner's judgment that they have provided in the guidance, which is the issue is whether premium is used either in a technical sense in terms of issue of a loan requiring repayment of a loan to be of a greater sum than was borrowed, whether that amount is fixed or calculated according to a formula, or in a more general sense of anything paid in excess of that borrowed, which was applied in the 1970 case in connection with the Protection of Depositors Act 1963, where protection of the public requires a wide meaning to be given to premium. In the context of being repayable at a premium, or its having been obtained or issued at a discount, it seems to me that premium is being used in the former technical sense that is customarily used in relation to loans. So clause 8.1 of the agreement provides that the borrower may prepay the loan in whole or in part without penalty on any interest payment date. I do not consider that a corporate finance expert reading the words of the exclusion at C above and those words of the agreement would consider that the loan was repayable at a premium because the indemnity payment for terminating the swap transaction was required to be made in consequence of the prepayment. So what this judge is in effect saying is, it's not a premium, and on the basis it's not a premium, under those technical terms based on all these different positions in the law back in the 60s and 70s, is that we are now in a position to say there that we need to consider, is it a premium or not? And if an expert would say it's not a premium, then it's not a premium, which means we are allowed to claim the early repayment charges. As many of you will know, most commercial loans will incorporate some sort of break clause or some sort of early repayment charge, which is basically a compensation to the lender should you end that agreement early. So it's always more about compensation rather than it being a premium. However, it may be, as a question of fact, be that particular individual loan arrangements may provide for a payment to be made, which, although described as a break payment, is in fact premium. The following characteristics may be indicative but are likely to be confined to schemes contrived for the purpose of avoidance, with substantial sums being present. The loan agreement is one of a number of transactions within the arrangement. The borrower and lender are connected. The rate of interest under the terms of the loan agreement is demonstrably uncommercial for either party. The break payment is disproportionately high in comparison to the principal or interest. The break payment was not contingent or solely contingent upon early redemption, and early redemption is predetermined. So there is certain things which may kick in with if you have specific arrangements. The general consensus here is going to be that most early redemption charges with a standard high street or specialist lender is going to be allowable for tax purposes. However, just watch if you haven't got any other specific arrangements which may fit into some of these criteria that would be more restrictive and you would not be allowed to claim it. As you can see, this is not necessarily completely a straightforward answer. And the reason it's not a straightforward answer is because we are talking about tax law, which is based on common law, and it's based on what cases we have seen. So the more cases we see in courts, the more clear the law becomes. And until that point, we're working on the interpretation of law. As we can say here from what the guidance is telling us, that generally the early redemption charges that we're paying on our commercial loans are most likely to be allowable for tax purposes. However, we just need to be aware of whether or not it might be classified as a premium, whether there is any more specific points on the loan that may have the impacts that make it disallowable. So just be careful if you're doing any specific loans which have quirkier terms and conditions, which have things in there that are not of the norm that you've normally had in your loan, as that may have an impact if you do have to end a loan early on what may or may not be allowable for tax purposes. For many of us, the expense is going to be allowable. So you can take that generally, hopefully you are going to be allowed to claim this expense, but you just need to be aware that there may be occasions where it is not allowable and have an idea of what or when that might be the case. Hopefully today you've discovered whether your early repayment charges or ERCs are going to be allowable for tax purposes or not. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.